Most people believe that building a serious investment portfolio requires a large amount of money at the beginning. They imagine that only people with high salaries, wealthy families, or insider connections can realistically reach six figures in investments. But history quietly shows something very different. Some of the most successful investors started with almost nothing. The real difference was in the amount of money they began with. It was their understanding of how the financial system works and how wealth compounds over time. If I woke up today with $0, no savings, and no investments, the path to building a $100,000 portfolio would not start with chasing risky opportunities or trying to guess the next big stock. It would start with understanding the economic system we live in and positioning myself inside it in a way that allows money to grow steadily. Modern investing as we know it did not always exist. In the early 20th century, stock markets were largely controlled by wealthy insiders, industrialists, and large financial institutions. Ordinary workers rarely owned stocks at all. But after World War II, governments and financial institutions began encouraging the public to participate in financial markets. Retirement plans such as employer-sponsored investment accounts and the rise of mutual funds opened the door for everyday people to become investors. One of the most important discoveries in financial research came decades later when economists began studying how professional investors performed over long periods. Researchers like Eugene Fama analyzed decades of market data and reached a surprising conclusion. Most professional fund managers failed to consistently outperform the overall market. In many cases, the expensive experts did worse than simply owning the entire market through diversified investments. This discovery helped popularize one of the most powerful investment tools available today, index funds, instead of trying to pick winning companies. Index funds allow investors to own small pieces of hundreds or thousands of businesses at the same time. This approach spreads risk and captures the overall growth of the economy. Historically, broad stock markets have produced average annual returns around 8 to 10% over long periods. At first glance, those numbers might not seem exciting. But when combined with time and consistent contributions, the results become remarkable. Someone investing $500 per month into a diversified market index, earning around 9% annually, could reach roughly $100,000 in about 10 years. That is the quiet power of compounding, the financial force that turns small, consistent investments into large portfolios. However, starting from zero introduces a challenge that many financial guides ignore. Before any investing can begin, there must be money available to invest. This is where many beginners make a critical mistake. They spend time searching for the perfect investment strategy before they have built consistent cash flow. Investments cannot grow without fuel. If investing is like planting seeds, then income is the supply of seeds that must constantly be added to the soil. Without that steady input, even the best strategy cannot produce meaningful results. For someone starting from nothing, the first priority should be building reliable income and creating a monthly surplus that can be invested. Fortunately, the modern economy provides opportunities that did not exist 20 years ago. The internet has created entirely new ways to generate income outside traditional employment. Freelancing platforms allow people to offer services such as writing, design, programming, video editing, or marketing to clients around the world. Remote work has opened global job markets to anyone with internet access. Digital products, online education, and content creation have created new paths for building income streams. Even modest additional earnings can transform a financial future. If someone starting from zero manages to generate just $500 of extra income each month and consistently invests it, the compounding process begins working immediately. Once consistent cash flow is established, the investment strategy itself can remain surprisingly simple. In fact, simplicity often outperforms complexity in the long run. The foundation of the portfolio would be broad market index funds that track large segments of the global economy. These funds represent hundreds or thousands of companies across multiple industries, reducing the risk of relying on any single business. Around 70% of the portfolio would go into these broad market funds because they provide exposure to the long-term growth of entire economies. As businesses grow, innovate, and expand, the value of the overall market tends to rise as well. The second component would focus on sectors driving technological and economic transformation. Throughout history, waves of innovation have created enormous wealth. Railroads reshaped transportation in the 19th century. Automobiles transformed industries in the early 20th century. The digital revolution and personal computing fueled massive growth in the late 20th century. Today, technologies such as artificial intelligence, cloud computing, semiconductor manufacturing, and digital infrastructure are shaping the future economy. Instead of trying to guess which specific companies will dominate these industries, investing in technology-focused funds provides exposure to the entire sector. Allocating around 20% of the portfolio toward innovation-driven industries captures potential high growth without relying on single stock predictions. The final portion of the portfolio would serve as protection during economic downturns. Financial markets move in cycles, and history shows that periods of rapid growth are often followed by sharp declines. Major crashes such as the dot-com collapse in 2000, the global financial crisis in 2008, and the sudden pandemic crash in 2020 demonstrate how quickly markets can fall. During these periods, diversified portfolios may lose value temporarily. Allocating roughly 10% of the portfolio to defensive assets such as bonds or other stabilizing investments can help reduce volatility and provide stability when markets become turbulent. Understanding market crashes is essential for anyone building long-term wealth. Financial history shows that downturns are not rare events. They're regular features of economic cycles. Panic spreads, investors sell, and prices fall rapidly. Yet something remarkable has happened after nearly every major financial crisis in modern history. Markets eventually recover and often reach new highs. Investors who panic during downturns often lock in permanent losses by selling at the worst possible moment. Meanwhile, those who continue investing during periods of fear often acquire assets at significantly lower prices, positioning themselves for stronger long-term gains once recovery begins. Despite this knowledge being widely available, many investors still struggle to build wealth. The reason is not lack of information, but human psychology. Financial markets are influenced as much by emotions as by economics. During booming markets, excitement and greed push investors to buy assets at inflated prices. During crashes, fear drives them to sell when prices are already low. This pattern repeatedly leads people to buy high and sell low, which is the opposite of successful investing. Studies consistently show that the average investor underperforms the market largely because of emotional decisions and constant attempts to time market movements. The modern financial environment adds another layer of complexity. Global debt levels have reached historic highs. Central banks heavily influence interest rates, and liquidity and rapid technological changes have accelerated trading and speculation. Yet one fundamental pattern remains constant. Productive businesses continue to grow over long periods. Companies build infrastructure, develop technologies, manufacture goods, provide services, and expand into new markets. As the global economy grows, the value of those businesses tends to increase. Owning diversified shares of productive companies allows investors to participate in that growth rather than trying to predict short-term fluctuations. If someone starting from zero were to follow this approach, 3 major lessons would shape the entire strategy. First, building income and consistent cash flow is the starting point of all investing. Without money flowing into investments regularly, compounding cannot work effectively. Second, simplicity often wins in the long run. Broad diversification through index funds allows investors to benefit from economic growth without trying to outsmart professional traders or predict market movements.
Third.
Time is the most powerful multiplier in finance. Compounding rewards patience, and the earlier someone begins investing consistently, the easier it becomes to reach large portfolio milestones. The biggest misconception about wealth is that it begins with large amounts of money. In reality, wealth often begins with understanding systems and using them correctly. The individuals who quietly build strong financial futures are not always the most brilliant analysts or the most aggressive traders. They are often simply the most consistent participants in the system. They invest regularly, remain patient during market cycles, and allow time and compounding to do the heavy lifting. What a world where financial systems operate on long-term growth and compounding returns! Patience can become one of the most powerful financial strategies anyone can possess. And for someone starting from zero today, understanding that principle can be the first step toward building a six-figure portfolio.